Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the Nasdaq Market site, we have Max Cabasso, Managing Director on Nasdaq's Market Intelligence Desk, as well as Phil Mackintosh, Chief Economist at Nasdaq. We'll be bringing in Brian Joyce, also Managing Director on Nasdaq's Market Intelligence Desk, for a technical read on the charts. It is great to see both of you, as always. Welcome back to TradeTalks. And Phil, it still seems to be the narrative with what's happening in the marketplace is really driven by Fed policy and inflation being sticky.
Yeah, but inflation, I mean, it's definitely sticky when you look at the headline number, but when you break down the components, when we were talking about inflation a year and a half ago, there was a lot of goods price inflation from the stockpile shortages and the COVID-induced shortages. Mm-hmm. There was energy price inflation from the Ukraine war. That created food price inflation. All of that's gone. So really what's left now is just two components, and a lot of what's in one component is insurance for cars. Mm-hmm. And a lot of what's in the other component is housing costs, so rent costs are high. And the forward indicators on both of them look like they're coming down. The trouble is both of the, like insurance is kind of like a delayed effect where the cars got more expensive because of the chip shortages, the parts got more expensive because of the actual supply chain bottlenecks, and then insurance companies suddenly realized all the claims were getting more expensive because of both of those things, so they put their prices up. It'll take 12 months for the premiums to filter through the CPI. Rents are kind of the same, right? We all sign 12-month leases, so if we're only up to the 11th month of people catching up to last year's inflation, the inflation is still going up in property. And so everybody's seeing the stickiness, but when you look at some of the forward indicators, it looks like inflation is going to keep going down, not up.
So auto insurance and home insurance in some cases up 22 to 25% from last year. So when you're saying it'll take 12 months for this to normalize, so this is it. This is the new normal.
Well, yes.
It's not like it's going to go down, is my question.
Prices are probably not going to go down. So the prices of secondhand cars did start to fall. The price of oil definitely fell, and it's been deflationary recently. So there's some things that are deflationary, but for the most part, prices went up. And as long as they don't keep going up, they contribute zero to inflation. So the new normal is the current price. I don't think we're going to see deflation in too many areas.
Right. So Max, we were talking about this yesterday. Even if we were to get 25, 50 basis points cut, it's not going to make insurance go down, as an example.
Yeah, again, those components, that's not really interest rate sensitive there. It's more to do with the supply chain and everything that happened during COVID. But even still, the market kind of pricing in a lot of even the 25, 50 basis point cut. You saw the price action on the first with the Fed meeting. The one-day straddle was pricing in basically a 90 bip move that day. S&P ended up falling, I think, 34 bips, 35 bips. So again, it seems like it's kind of priced in. I think the status quo is now priced in. And again, it's as long as we don't see that pick up in inflation, the Fed has been pretty clear they want to cut. They're waiting to see something that you can kind of confirm what they want to do. They came out and said we're not going to be raising rates. I don't think they're very concerned. Like you're talking about, we're not seeing anything of a real pickup in inflation. So again, with those known kind of two components, if we don't see anything pick up, is that going to change their mind as to, okay, we're comfortable now because it's just these two kind of components that are keeping things sticky, or okay, we're comfortable to cut. Again, because even if you do cut, it's not really going to have a big read-through to those two sectors, so it's not going to make a big impact there. So maybe they're more comfortable. They're starting to see some more worrisome headlines and data coming in the back half of the year, that they might be more comfortable to cut, because again, they're not worried that that cut is going to then spur those prices to reinflate.
And Phil, that's the concern here for the average consumer. This is what we do for a living. We pick apart these numbers. While the economy is strong, which is why the Fed isn't immediately cutting, for the average consumer, it was a poll I read yesterday, I can't attribute it, I don't remember the name, but the biggest concern going to the election was the economy, because the consumer hears my rates are up 22 to 25%, and to your point, if it doesn't go up any higher, that's technically 0%, but
I know what you're saying. It's pocketbook that you feel, but the data also shows that wages have gone up, and actually they've gone up faster than inflation if you look over a few years. So real income has increased because the economy's been so strong. So we're spending more, but we've actually got more money as well to spend. And that's one of the reasons why people say the consumer is still powering through, even though all the money that we saved during COVID theoretically has run out by now. The wage increases have now starting to kick in and helping people spend too.
Yeah. Well, let's take a look at the chart here at our 10-year. Brian, if you could pull that up for us and get a technical read on what's happening in the rate environment.
Hey, Jill, thanks for having me on. So we could see that the 10-year yield bottomed back in the end of the fourth quarter of 23 and just been trending higher. So recently peaked in the final week of April up around 4.7%, and has pulled back now last to it peaked around 5.25, and now we're last around 4.84%. So a lot of volatility right there. In the near term, we've seen that pullback, but interestingly enough, the rate-sensitive industries like financials, the regional banks, the large cap BKX bank index is trading very close to their 52-week highs. And so the market has been resilient all throughout this year when the rates have been moving higher off those lows.
Yeah. Well, Phil, this is what's interesting, and I have some geeky data for you here. But the longer that the Fed pauses, and our current one as of yesterday is 280 days, the second largest in modern market history, trailing only 2006 to 2007, the S&P actually performs better the longer the pause, which I thought was interesting.
Yeah, I guess you've got to think about why rates are high in the first place. It's because the economy is overheating. And so if you get to a point where it's like, I don't want to go anymore, but the economy is still hot, it's still going really well, and that's exactly where we are right now. The only soft spot is if you look really carefully at some of the labor market indicators, little bits of leading indicators that maybe small companies are intending to hire less, maybe some of their margins are getting squeezed by the higher interest rates now. But large cap companies, they've locked in their debt at the really low interest rates, they're growing sales because of everybody spending more, even in real terms, and so they're growing margins and their profits are up. So the market's actually justified by the strong economy too.
Right, well, I mean, that's the question we're asking, right? Do you want a rate cut or do you want a healthy economy?
Yeah, I mean, look, you want the strong economy. We seem to be able to digest these higher rates now. It hasn't obviously bled through. We've seen companies perform through this. Now again, there's been that divergence between the large caps that are well funded, their balance sheets are really strong, versus some of the smaller caps that have kind of a weaker balance sheet that are more interest rate sensitive. They're going to have to go out and refinance. We've seen again the divergence of the Russell 2000 and the micro caps versus the large caps. So we're kind of seeing that play through in the market. But in the grand scheme, you want the stronger economy. So again, we seem to be digesting it better. The volatility seemed to be on the way up, and then obviously pricing in 6 cuts now down to 2. That caused a little bit of a tantrum. But as we talked about, I think it was last week, market is still strong. We went from 6 to 2, and we're still basically just off all-time highs. It's looking strong. So again, we're not seeing those big layoffs. Now, obviously, small business, if that starts to pull back, that could be a problem. But again, for the broader markets, for the stock market, they'd obviously much rather prefer the strong economy. Again, like we talked about yesterday, some of the data, some of the security providers, internet security, they're talking about a bit cloudier in the back half of the year, and that's why they weren't upping their guidance for that back half of the year, a bit more cautious. So again, they're more cautious, but they're still confident enough. It's not like they're taking down their numbers. We're seeing these big, declines. The sell-offs we've seen in some of the stocks and with earnings have been because they're not upping the guidance, and that was kind of being priced in. But we're not seeing cuts where everybody's saying, okay, no, things are really bad. It's just being more cautious as again, we kind of see how it goes. Does the Fed end up cutting? But
well, it's also the first quarter, right? We know guidance isn't necessarily, yes, you have 3 more quarters that you have to execute on.
Yeah.
All right, let's bring Brian back in here for a moment. Let's take a look at the S&P 500 from a technical perspective.
So Jill, so the S&P 500, we're now in our 3rd week in a row of moving higher off the lows. The pullback from the high to low was less than 6%. So following the prior 5 months ending in March, where we had phenomenal gains, back-to-back quarters of double-digit gains, that's happened less than 10 times in the history of this index. The pullback has been relatively modest, and so it's good to see that despite this move higher, particularly in the month of April, in the interest rate complex, that equities have been able to hold up. And you can see here the breadth still pretty good as well, with showing 77% of the members within the S&P 500 are trading higher than the 200-day moving average. So I think overall the S&P 500 definitely still looks constructive. We see this phenomenal run here over that 5 months, the pullback, and now it looks like we're marching higher, not too far away from making new highs. The recent rally of the last month or so, we have seen defensive groups like utilities and consumer staples, as strong performers. So it remains to be seen how that plays out going forward, but overall there's nothing really very concerning from a technical standpoint.
All right, and earnings were decent. We're over the hump at this point when it comes to earnings, broad-based across sectors, which is of course an encouraging trend. But we had those valuations in 2023 that really were the genesis behind those gains there. So really for the remainder of 2024 is you're going to have to show profit growth.
Yeah, so a lot of the earnings growth that's come through has actually been in the Mag 7 and the AI complex. If you look at the earnings of the other 493 companies in the S&P 500, it's growing, but much more slowly. The forecast, if you look at the analyst estimates, are for that to start to shift back to a more normal blend, where because it speaks to the broadening of the rally as well, where more companies are going to grow their earnings, and then it trickles down to the mid cap, and then later this year it trickles down into the small cap as well. So the outlook for earnings when we get to Q4 is much more broadly to have earnings growth across the whole complex.
Yeah. Well, Phil, buyback activity surged to its fastest pace since 2018, on pace for more than $1 trillion for the year. What's the significance of that?
Well, and some of the big tech companies started paying dividends for the first
Yes.
time. So what you're seeing is, what's interesting with buybacks is a lot of companies will pay dividends consistently, but when they have extra money, they'll buy their stock back. And it's, you know, it's just a way of deploying capital back to the investor. Whether the investor can sell into the buyback or they receive a dividend doesn't really matter. There's a little bit of a tax difference, but what you're basically seeing is a lot of cash flow coming into a lot of companies, and they're just doing their buybacks to share the money back to the investors.
Right. Well, doesn't it also suggest that they feel that it's a good value for them to buy and deploy their capital at that price, or
Academically, that's not completely clear. So that's what you hope, is that the company realizes that the best way to deploy the capital is to buy their stock because their stock is relatively cheap, and then they increase their earnings per share because there's less shares, same amount of earnings, which increases the valuation. Some companies are good at it, some companies are less good at it, but overall, you can track things like a buyback ETF or a buyback index. They typically track the market pretty well.
Interesting. And to close out here, Max, anything that you're hearing on the intelligence desk in terms of what sectors were outperforming, or the companies that you speak to directly, our issuers, where they're seeing bright spots?
Yeah, it's funny, actually, I had a conversation with somebody recently going back and forth about dividends versus buyback, and talking about variable versus once you put the dividend in, if you take your dividend away, it's going to be a pretty negative signal, but your buybacks, they're variable. You kind of choose when to deploy it. But no, I mean, look, tech has been strong. The AI hype cycle is maybe less of a hype cycle. It's starting to kind of read through, but that narrative has remained intact with this most recent earnings quarter. It's been strong. Obviously, the semis are still performing well. That was kind of the one to watch. Everybody's looking, all right, are the semis going to roll over? If the semis roll over, they've really been driving a lot of the gains. If they turn, is that going to get nasty in tech land? It didn't happen. So it's been pretty strong across the board there. Semis, again, though, are really the big focus, obviously because of AI, and that narrative has remained intact as everybody thought, okay, this might be the quarter it needs to really get pulled in and start showing some performance, and it's still there. So maybe we have to stop calling it a hype cycle and turns into actual performance for the company. So that's the one that we've been kind of keying on in that space.
All right. Appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.